Most traders don't blow up their accounts because they're reckless. They blow them up because they're disciplined. It sounds strange, right? They follow the rules. They track their risk. They study charts for hours. They journal every single trade. And then, one single decision erases years of hard-earned progress. Not because the market did something unexpected, but because they convinced themselves to stay in a losing trade when every rule they had screamed at them to get out. There is a silent killer in trading psychology that destroys even the most structured, intelligent, and disciplined traders. It's called position justification. And if you've ever found yourself holding the losing trade, just hoping it would come back, this video might feel a little uncomfortable, but it's absolutely necessary. Position justification isn't some emotional panic. It's far more dangerous. It feels rational. It sounds logical. It cleverly disguises itself as patience, deep analysis, and confidence. It happens the moment a trader stops managing risk and starts defending their decision. The second you begin explaining why you can't possibly be wrong, you've stopped trading and started protecting your ego. And here's the brutal truth. The more disciplined and analytical a trader is, the easier it becomes to justify staying in a losing position. Why? Because intelligent traders don't lack explanations, they just create better ones. They can always find alternate technical interpretations, macro excuses, news-based rationalizations, or historical comparisons that support their bias. But markets don't reward explanations. Markets reward execution. Let me introduce you to Boris. Boris was the trader everyone in his circle respected. He had a structured trading plan he followed religiously. He risked only 1% of his account per trade. He journaled every decision, and he waited patiently for only the highest probability setups. For 2 years, he was consistently profitable. Then, one trade changed everything. Boris entered a textbook breakout setup. It was perfect. The structure was clean. Volume confirmed the move, and the technical alignment was undeniable. But shortly after he entered, the price reversed. Normally, this would have been simple. His stop loss was clearly defined. But this time Boris noticed something. A higher time frame support level was sitting just below his stop. So, he moved his stop a little lower. It didn't feel emotional, it felt logical. Price continued dropping. Now Boris found new reasons to stay in. He convinced himself the market is just shaking out weak traders. Instead of closing the position, he reduced its size. Then, the price dropped again. Now, he added to the position, convincing himself he was just improving his average entry price. Weeks later, Boris finally closed the trade, not at a small, controlled loss, but at a catastrophic, account-damaging loss. But the real loss wasn't just the money, it was his discipline. After that one trade, his trust in his own system completely collapsed, and his performance never recovered. Position justification almost always hides behind 5 common lies we tell ourselves. Lie number 1, it will come back. This is just hope disguised as analysis. The market doesn't owe you a return to your entry price. Hope is not a risk management strategy. Lie number 2, I just need to give it more room. More room usually just means less discipline. Professional traders define their risk asterisk before asterisk they enter a trade, not after the price starts moving against them. Lie number 3, the setup is still valid. Maybe it is, but your risk parameters are no longer valid, and trading is always risk first, setup second. Lie number 4, if I close now, I lock in the loss. This is a mental trap. The loss is already real the moment the market moves against your plan. Closing the trade doesn't create the loss. It stops it from getting bigger. And lie number 5, I've been right before in this situation. Past luck is not a statistical edge. Markets change much faster than a trader's confidence. Now, let's meet Marcus. Marcus isn't smarter than Boris. He isn't more analytical, but he survives because he follows one simple rule. He treats justification as a danger signal. The moment Marcus hears himself explaining why he should stay in a losing trade, he exits. Immediately. No debate. No looking at a second chart. No emotional negotiation. Marcus believes something that most traders struggle to accept. Being wrong quickly is much cheaper than being right slowly. And over years of trading, that single mindset has preserved both his capital and his confidence. So, how do we fight this? Here are 10 protocols that professional survivors use. Protocol 1. Predefine your exit before you ever enter the trade. If you're deciding your exit rules while you're emotional, they are no longer rules. Protocol 2. Use automated stop losses. Automation removes the temptation to negotiate with yourself. Protocol 3. Journal your emotional reasoning. Write down your justification thoughts. The patterns will quickly become obvious. Protocol 4. Set maximum time limits on your trades. If the market doesn't confirm your thesis within a certain time frame, just get out. Protocol 5. Separate analysis from execution. Do your analysis when you're flat, not when you're in drawdown. Protocol 6. Accept loss as an operational cost. A loss is a business expense, not a personal failure. Protocol 7. Limit your position size. Smaller positions reduce your emotional attachment and make it easier to follow your rules. Protocol 8. Create a justification checklist. If you hear yourself saying phrases like, just a little longer, or it usually rebounds from here, that should trigger an automatic exit. Protocol 9. Review your losing trades weekly. The patterns of justification repeat themselves long before traders notice them. And Protocol 10. Measure your success by how well you follow your rules, not by your profit and loss. Processed consistency is what creates long-term profitability. The goal in trading is not to be right. It is to be disciplined when you are wrong. Perfect traders don't survive because they predict markets better. They survive because they respect risk faster. The market punishes ego, but it rewards execution. If this video made you feel a little uncomfortable, that's good. It means you recognized something real in your own trading. Because position justification doesn't destroy the reckless traders. It destroys the disciplined ones who stop trusting their own rules. So I want to ask you something. Have you ever stayed in a losing trade because you convinced yourself it would recover? Comment justified below if you've done it before. It's more common than you think. And if you want more content on trading, psychology, discipline, and building a professional trader mindset, subscribe to the channel. Because that's exactly what we focus on here. Thanks for watching.
In the world of trading, we're often told that victory belongs to the smartest, the most brilliant, the ones with the most complex algorithms. But that's a lie. Victory isn't claimed by the brilliant, it's claimed by the disciplined. And even for them, there's a silent killer, an enemy that stalks the most perfect traders, whispering from inside your own mind. It's called position justification, and it's the psychological trap that turns winners into cautionary tales. This isn't a story about Lambos or easy profits. This is a raw, honest look at the mental battlefield where fortunes are truly won and lost. So, if you're serious about not just making money, but keeping it, stay with me. Let's talk about Maya. By every metric, Maya was a perfect trader. Her strategy was a masterpiece of logic. Her execution was precise, and her discipline was legendary among her peers. For years, she meticulously built her empire, one calculated trade at a time, creating a monument to cold, hard logic. She was the trader everyone wanted to be, but one day, a single position, a routine trade, turned against her. At first, it was a small loss, the kind of thing that happens every day in the market. But this time, something was different. Something inside her snapped. Instead of cutting it loose, her standard procedure, she held on. It's just a pullback, she told herself. That was the first lie. The market didn't listen. It dipped further. Her small loss started to grow, becoming uncomfortable. The fundamentals are still strong, she rationalized, clutching her initial analysis like a holy text. That was the second lie. She scrolled through forums, looking for any scrap of information that confirmed her bias, ignoring the roaring chorus of the market screaming that she was wrong. As her account started to bleed, as the red numbers grew larger and larger, the final, fatal lie took hold. I can't take a loss this big. It has to come back. It never did. The market, in its impersonal way, continued its descent. Maya, the perfect trader, the legend, was wiped out. Not by a market crash, not by a black swan event, but by a single decision, a single, catastrophic failure to accept reality. She wasn't beaten by the market. She was destroyed by her own justification. Maya's story is a tragedy, but it's not unique. It happens every single day. Traders, both new and experienced, fall into the same trap, telling themselves 3 core lies to justify a losing position. The first and most common lie is, it's just temporary volatility. They mistake a fundamental shift in the market's direction for simple, random noise. They see a crack in the dam and convince themselves it's just a small leak that will fix itself. They cling to the hope that the trend they were riding will magically reappear and save them. But hope is not a strategy. Mistaking a tidal wave for a ripple is a deadly error. The second lie is, my analysis is still valid. This is the ego-driven lie. Traders become married to their initial thesis. They've done the work, they've studied the charts, they've read the reports. They feel they must be right. So, they ignore the mounting evidence to the contrary. They filter out any information that contradicts their worldview. They forget the most important rule of the markets. The market is always right. Your analysis, no matter how brilliant, is not infallible. When the price action tells you your story is wrong, you must listen. Arguing with the tape is like arguing with the ocean. You will always lose. And the third lie, the most dangerous of all, is, I'm too deep in to sell now. This is the sunk cost fallacy in its most destructive form. The loss has grown so large that the pain of realizing it feels unbearable. So they hold on, letting a bad decision dictate their future ones. They double down, averaging down into a losing position, throwing good money after bad. They transform what could have been a manageable, educational loss into a catastrophic, account-ending one. They're no longer trading their plan. They're trading out of fear and desperation, praying for a miracle that rarely comes. Now, let me introduce you to another trader. His name is Marcus. Marcus is a survivor. He's been in the game for decades. He's seen traders like Maya come and go, brilliant flames that burned bright and then burned out just as fast. Here's the thing. Marcus isn't necessarily smarter than Maya was. His strategies aren't some secret magical formula. But he possesses one skill that she lacked, a skill more valuable than any indicator or algorithm. He has the brutal, unflinching ability to recognize justification the moment it whispers in his ear, and to cut it out like a cancer. When a trade goes against Marcus, he doesn't hear whispers of hope. He hears a blaring warning bell. He doesn't see a position tied to his ego. He sees a number on a screen. And if that number breaches his predefined risk limit, his stop loss, he acts. There is no hesitation. There is no emotion. There is no second guessing. He executes his exit. Click. Done. He takes the small, planned loss and moves on to the next opportunity. He survives and thrives because he kills his ego before it has a chance to kill his account. He understands that his job is not to be right. His job is to manage risk and stay in the game. So how do you stop being a Maya and start being a Marcus? How do you cultivate this survivor's mindset? It's not about willpower, it's about process. It's about building a system of rules that protect you from your own worst instincts. Here are 5 practical, non-negotiable protocols to build that system. First, define your exit before you even enter the trade. Your stop loss is not a suggestion. It's not a vague idea. It is the law. It is your contract with yourself. You must know, to the exact tick, the point where your trade idea is proven wrong. And when that point is hit, you get out. No exceptions. This single rule is the most powerful defense you have against position justification. Second, write down your trading plan. I mean physically, write it down or type it out. What are your entry criteria? What is your exit criteria? What is your position size? Having a physical plan that you can see and touch makes it real. It forces you to confront your rules in the heat of the moment and makes it much harder to break them on an emotional whim. Your written plan is your anchor in the storm of market emotions. Third, Conduct a post-mortem on every single losing trade. This is crucial. After the dust has settled and the emotion has faded, go back and analyze the trade. But don't just ask what went wrong with the chart or the setup. Ask yourself, what went wrong with my thinking? Did I follow my plan? Did I hesitate? Did I let a small loss turn into a bigger one? Was I telling myself any of the 3 lies? This ruthless self-interrogation builds the self-awareness you need to spot justification early. Fourth, set a maximum daily loss limit. This is your circuit breaker. Decide on a percentage or dollar amount that, if lost in a single day, means you are done. You close your platform, you turn off the screen, and you walk away. Period. This prevents a single bad day, where you might be emotional or off your game, from spiraling into a week of revenge, trading, and blowing up your account. It contains the damage. And finally, number 5, practice acceptance. This is the mental side of the game. You must accept, deep in your bones, that you will be wrong. A lot. You must accept that you will have losses. It's a non-negotiable part of the business. The market does not know you exist. It does not care about your opinion, your analysis, or your feelings. It only rewards one thing over the long run: discipline. True acceptance means a loss is no longer an assault on your ego. It's just a business expense. Position justification is the siren song of the trading world. It's a sweet, tempting melody that promises a return to safety, a return to profitability, all while luring your ship onto the rocks of financial ruin. It whispers that you're right, that the market is wrong, that you just need to hold on a little longer. But it's dragging you deeper into the abyss with every tick. The only way to win is to refuse to listen to that song. You have to lash yourself to the mast of your trading plan. Be like Marcus. Be a survivor. Acknowledge the truth, kill the justification, and live to trade another day. Thanks for watching. If this message resonated with you, hit that subscribe button. Let's build a community of disciplined traders together. See you in the next one.